What if I tell you I have found a graphite mining company which is actually already producing graphite, has an offtake agreement with Tesla ready to go, and is trading well below a $1 billion market cap? Well, that is the company we are talking about today. Welcome to the next installment of Analyzing Your Stock Picks, the series where I, analyze your stock picks. Today we are looking at Syrah Resources Limited, or these ticker symbols. A company overview. Quick overview of the company we are looking at. These are the two main sides of the Syrah Resources business that you should be aware of. First, the Balama mine. This is Syrah Resources' own graphite resource located in Mozambique on the continent of Africa. As of the latest quarter, the company was producing graphite at a pace of 46,000 tons of graphite per quarter at a cost of around $500 per ton. We do not have to worry about the mine running out anytime soon, since it has a projected life of mine of around 50 years. The total graphite content of this resource averages in the range of 10 to 16%, which is, as you probably know, well above interesting. As we saw just a bit ago, the company is currently running at a cost of around $500 per ton, but the company hopes to get this number down all the way to $330 per ton at full capacity, which would be mind-boggling. This is what the processing plant is looking like, and it is quite the beauty. And by the looks of it, it has been operational since early 2018. So that is one side of the business, the mine. But just as with Novamont Graphite and Gratomic, the graphite straight out of this mine is not suitable for electric vehicles just yet. And that is where Vidalia comes in. Vidalia is Syrah Resources' own anode material facility. As of the latest studies, Vidalia should be able to output 21,000 tons of anode material per year at a cost of around $3,100 per ton. Keep in mind, however, Vidalia is not operational just yet. The company is aiming for a Q2 2023 expected construction completion and a Q3 2023 target start of production. I believe this anode facility should be the main thing that you are interested in. For one, this anode facility is the only reason that Tesla was ever able to sign an offtake agreement with Syrah Resources. And the second reason why anode material facilities are so interesting: anode materials sell in the range of around $10,000 per ton, while normal graphite only sells in the neighborhood of $2,000 per ton if you are lucky. So Vidalia is a multiple expansion machine. It turns the cheap stuff into very expensive material, which can then be sold to the highest bidder. As a quick summary, this is the Syrah Resources setup. First, we have the Balama mine in Mozambique, which produces reasonably pure graphite, which in turn can be sold directly or shipped to the US. In the US, we have the Vidalia plant, which can turn this cheap graphite into very expensive anode material, either coated or uncoated for their respective end markets. So that is my global overview of the Syrah Resources business. Now let's dive into a financial overview. Even though Syrah Resources managed to do $29 million in revenue during 2021, the company was also able to lose up to $57 million during that same time period. Why? Well, a huge chunk of those costs are associated with this one, cost of sales. I believe over time, as the mine becomes more efficient, this number should decrease relative to the revenue. And aside from that huge cost of sales number, the company doesn't really seem to have any unreasonably high expenses. As of the 31st of December, the company sat on a cash pile of about $53 million. It had about $20 million in inventories. It sat on a property, plant and equipment position of about $181 million. And it had about $133 million in book value mining assets. And all those current and non-current assets combined gets the company up to a $430 million asset position. Liabilities wise, the company had about $18 million outstanding on the short term, while having borrowed about $70 million on the long run and having some lease liabilities. And well, if we take all the assets minus all the liabilities, we'll get to a total equity position of about $293 million. Meaning, book value wise, the company is worth about $293 million. While on the stock market, the company is worth about $730 million instead. And that means that you as an investor are paying about 2.5 to 3 times book value on the stock market. Book value for sure isn't the be-all end-all valuation metric. For example, I would not mind paying even 10 times book value if on a profit basis that made sense. Book value is just another tool you can use to compare companies and just another tool you can use to get a clearer picture of what you are paying for a stock. Important to note, the company is still actively investing in property, plant and equipment, and for the foreseeable future they will continue to do so. We can expect this number to stay reasonably high at least until the Anode facility is up and running. And I think that is the main gist of the financial position that you should be aware of. Of course, you should do a way deeper dive before you ever decide to invest, and you should keep in mind that I am no financial advisor. However, now let's talk about my opinions. Actually, I like the company, I really do. I love the public Tesla partnership, and I also love the dual track approach with both the mine in Afrika and the Anode facility in the US. I'm also quite happy the company has come off its recent highs, where it was trading well above a $1 billion market cap. But the company still isn't cheap. During 2021 they had about $29 million in revenue. And that means at the current share price you are paying about a 25 to 30 times price to sales ratio, which is enormous. Although the company is growing exponentially. And rough napkin maths here, the company should be able to get up to hundreds of millions of dollars in revenues reasonably soon. However, the price isn't right now for me. You see, as an investor, I am constantly comparing to my opportunity cost. And this bad boy is my opportunity cost. This is my yardstick. Thanks to the most recent downturn, Gratomic is only an $80 million company, while I still believe them able to get up to hundreds of millions of dollars in revenues reasonably soon too. Arguably, that's about a 10x better price than Syrah Resources. Doesn't mean that Gratomic is a better investment per se. After all, Gratomic is still hella risky. And to be completely fair, Syrah Resources has de-risked itself significantly through their public studies, through their mine being operational, and through the public Tesla partnership. So yeah, obviously you are paying more for Syrah, but it's also significantly less risky. The choice is, as always, yours to make. Personally, I am keeping Syrah Resources on my radar, and maybe one day when I have the cash and they are significantly cheap once again, I'll buy some shares. Until then, thank you so much for watching. Peace.